I lost my notes, but I don't think I need them.
It's a bold strategy, Cotton. Let's see if it pays off for him.
All right, this is episode 10 of Farm to Markets, where we talk about everything from farms to stock markets. Today, we were talking about payment of order flows, where to save your down payment for your house, and we're going to watch some TikTok videos. The SEC recently signaled that it is open to banning the practice known as payment for order flows. Since Charles Schwab pushed the brokerage industry into the world of commission-free trades, selling client order flows to third-party markets has been a way for brokerage firms like Robinhood, Schwab, and TD Ameritrade to recoup a lot of the revenue. The question is, do you think payment for order flows should be banned? And to kind of preamble a little bit before I ask the first question to Drew here, is I'll explain a little bit about what a payment for order flow is. So essentially, if you're on the TD Ameritrade website and you want to buy some shares of Tesla, you go into TD Ameritrade, you fill out your ticket and you hit buy, and that order will essentially go to TD Ameritrade. TD Ameritrade will take that order, and what they can do is they can sell it to what they call a third-party market maker, who essentially filled that order. So TD Ameritrade gives it to the third-party market maker. The market maker will take it into the market. They'll look at all the markets. They'll look at the New York Stock Exchange, the NASDAQ, some of the private markets, and they're required to find you what they call the national best offering price. And in some cases, through high frequency trading, they can actually get you a better price than what's actually quoted in the market. And then what they do is they bring that price back to TD Ameritrade and say, hey, we filled your shares of Tesla at this price, which is 1 cent better than the national best offering price, and give it back to TD Ameritrade. And essentially, the market maker makes their money by making the difference between the selling price and then the buying price. So is that if they're selling it, they'll sell it for about a penny more than what the actual sale price was listed as. And if it was a buy order that they're trying to fill, they'll buy it for about a penny less than what was actually listed for, and then the market maker will take that penny. And then essentially what happens from there is that to kind of to show TD Ameritrade or whoever the brokerage firm their appreciation for giving them the rights to fill that order, they'll give them half of the profit that they made, so about a half a cent. So the market maker keeps a half a cent, and then TD Ameritrade gets a half a cent, and then that client's order gets filled. And this all happens in the fractions of a second after you hit the buy. After you hit the buy button to place your trade. So again, is that the SEC is thinking about banning this practice of selling clients' order flows, because essentially what can happen is that market makers can offer brokerage firms a little bit more than another market maker would to entice them to give them the order flows. And the risk is that they're not getting the absolute best price. So the SEC has been very concerned about this since Robinhood since the brokerage industry was pushed into the world of commission-free trades. And this has been a greater source of revenue for each brokerage firm. So after that long-winded explanation, Drew, do you think payment of order flow should be banned by the SEC?
I don't. I think that putting restrictions on payments for order flows is the SEC basically throwing the baby out with the bathwater. What they're trying to do is make the markets more transparent, and this is at the cost of making them less efficient. I believe if you let the markets behave organically, they'll find the most efficient way to operate. And in the case of payments for order flows, I think everybody wins. Trades cost less to the investor. The brokers make money, and the third-party market makers make money as well. Now, as you said, Tom, there certainly is a potential for a conflict of interest, as brokers basically get to choose where the orders go. They can charge the spreads themselves, or they can send it off to a market maker, depending on which one is best for them, not necessarily best for the investor. But we live in the era of instant global communication. Information travels fast. When there's even a whiff of unscrupulousness going on in the markets, investors will be quick to take note, and they'll adapt. Brokers and market makers will have to change, or they'll have to become obsolete. I think that there is enough transparency in the markets that consumers have enough information to inform themselves on what they are purchasing and how they're purchasing it. at this point, I think my solution would just be become a more educated consumer.
Okay. Alex?
Well, as far as whether or not it should be banned, I would say almost certainly no, if for no other reason, then I'm not sure how else these companies are going to make money. If you can't charge for transaction fees because everybody else is not charging, if everybody's blocking ads, you can put ads on your website or in your app. At a certain point, these companies have to be able to make some money, and this has become one of the bigger ways that they're doing it. I understand that there is the potential for kickbacks and, essentially bribery and fraud and graft and all that stuff. But at the moment, there really just doesn't seem to be a better option here. If you ban them, you're either going to force everybody to go back to transaction fees, which nobody likes, or they're going to find some other new, interesting, creative way to make money off of it that may be even more prone to bribery or graft or fraud. As for whether or not I think it'll be banned, I don't know, but it's already banned in the UK and Canada, among other places. So I think there's at least a coin flip's chance that it will be banned, whether it should or shouldn't be.
Joe?
Well, it's not very often that anybody picks up the phone and calls me and asks me what my opinion is, except on farm to markets. But if I had my druthers, I would say the SEC ought to leave this well enough alone. When I first started in the business, there was what was called the odd lot cost for placing trades. If you bought less than 100 shares, you had to pay an extra fee. And in those days, trades were placed on an eighth of a dollar. So you bought it for 27 and an eighth, or 42 and 3/8, and so on and so forth. And brokerage firms would make a profit on the differential between the eighths. Then we got to the point where we broke it down into pennies, and now I hear there's talk of shares trading in half a pennies or a fraction of a penny. All of these things have made it much easier for the small investor to participate in the markets. If the SEC comes in here and takes away the right for payment for order flow, the ultimate person who gets hammered is going to be the small individual investor who does it themselves. We can go back to the days where investing was very, very difficult, very complex, very expensive, and only the very wealthy did it. Or we can leave well enough alone and allow as many people as possible to participate in having their money grow faster than the rate of inflation and taxes. So I'm opposed to it, but like many of you gentlemen have already stated, whether it's good or bad, it just is. And if they do it, well, Coco Enterprises will just adjust and adapt, and we will we'll respond to the market decisions.
Like everybody, I also am opposed to it. I don't want to see it get banned, because right now, TD Ameritrade's telling me is that on every 100 shares that they place, they're saving investors about $1.75 in trading costs. So right now, the third-party market makers are making money, TD Ameritrade's making money, and investors are saving about $1.75 for every 100 trades that are placed out there. I don't see, at this point, I don't see any issues with it. I know Robinhood is almost 100% of Robinhood's revenue is based on payment for order flows, and I don't even know if they're registered with a national market exchange, because I think they just use third-party market makers to place all their orders, which like Alex said, sets them up to where they could be susceptible to bribery, and I think there was even a little bit of an issue where they were placing orders that were not quite at the national best offer rate, but I think they've gotten that under control. And as long as, if the SEC wants to do anything, what they could do is just advocate for a standardized reporting among brokerage firms. So financial advisors and retail investors can go in and look and see where their orders are getting placed and see how much money they're either saving or overpaying, and then make decisions for themselves. Okay, ever-increasing home prices means that first-time home buyers must save greater amounts to come up with a 20% for a down payment on their house. The question is, where should they be saving this money? Should they be saving it in a bank account that's giving them 0.01%? Should they be investing in the stock market, or should they be doing something else? And Joe, what do you think?
I think it depends on the time horizon and when you think you're actually going to be purchasing the house. If it's going to be 1 year or less, then the cash ought to be saved in a bank savings account or a money market account or something that's FDIC insured and liquid. If it's 1 year or longer, then you may want to consider maybe certificates of deposits or laddered bonds. Not to be crassly commercial, but our very own dynamic sector selection strategy seems to have relatively low volatility, which might be a good place to park down payment saving money if you're not going to be making a purchase in the next 3 to 5 years. So I really think it depends on when you think you're going to be making that purchase. That should drive your decision.
Alex?
Yeah, I agree with that. If you're going to be buying in the next few years, just throw it in your money market account, or maybe buy a short-term CD or something at the bank. Longer term, might as well just try and grow it while you can. That said, and this may not be a popular thing to say here, but right now there's basically no reason to put any money down. Banks aren't requiring it in most of their mainstream lending programs, and interest rates are rock bottom. So, I mean, if you can get away with putting nothing down but fees, personally, I don't see any reason to throw 20% down on a house at the moment. But short term, just cash. Longer term, probably stock market.
This is the part where the Coco Enterprise van pulls up to Alex's house and abducts him, and then you never see him again.
Come on, let's go. Nice and easy. There we go.
There'll just be the three of us next episode.
Yeah. Exactly, yeah. And Drew, what do you think?
I agree with what these guys said mostly. Not just because I want to keep my job because I like working here at Coco Enterprises, but I also believe in the what they said. If it's short term, if it's less than a year, keep it liquid. Be patient. It's easy to get swept up in hot markets, especially real estate right now. A lot of people that I talk to are really interested in these low interest rates. Locking in a home at 3% or less. And interest rates are kind of a double-edged sword. There's an inverse relationship with them. Just because money is cheap, it's easy to borrow. It does mean that the price of homes is going to go up. So just because you can nab a low interest rate doesn't mean you're getting the best deal. When interest rates do go up, the price of homes will fall as well. So any savings there will pretty much be voided. So I just say be patient. Less than a year, keep it liquid. Over a year, look at some real conservative options.
The only thing I'll add to that is risk tolerance. So is that if you're saving, if you have like a 5-year time horizon, and the market's making 10% moves, and you got $50,000 saved, you're either going to make $5,000 or you're going to lose $5,000. And if you get the unfortunate event where the market falls, between 40 and 50% in a couple months, then you're going to have to prolong your plans to buy a house, or you might miss out on a house that you're trying to buy. But ultimately, time horizon is key, and the closer you are to buying your house, the less you want to have. The closer you are, the more liquid and safer you want to have your money. And the farther you out, then it just becomes a matter of risk tolerance. If you're 6 years away from buying a house, do you want to take the chance that the market might be dropping like a 40% or 20% correction or something like that? And yeah, you'd have to postpone your house buying plans. It's kind of up to you at that point.
Tom, is that when you take a look at our Wealth Builders milestones template, milestone number 4 is buy a home. But for a lot of our clients, we've been telling them that once you get your 3 to 6 months worth of emergency savings completed, it's not a bad idea to open up a Roth IRA and just invest in your Roth IRA and be mindful that those funds could be available for a first-time home purchase, even if you're younger than 59 and a half. You can take out up to your contributions without a penalty or a tax, and you have access up to $10,000 worth of growth without having to pay a penalty. So it's a nice deal. And so a nice place to put money away for a down payment might be your Roth IRA.
All right, so for the first time, we are going to we're going to watch some TikTok videos. TikTok has been all the rage with the kids these days, and apparently there's been quite a bit of financial advice going around on TikTok. So we're gonna watch some of this some of these videos on of I don't even know I think you call them talkers, and give them financial advice. And I just want to get your reactions and thoughts. All right, so.
How to make your first million in 2021. You want to be between the ages of 23 and 25, and you live in the USA. Step 1, open a binary options trading account. You do this by going to pocketoption.com, registering for an account. You go to finance, you choose deposit, click deposit now. You could either pay with a MasterCard or Bitcoin, fund your account with $50. Find a mentor to teach you how to trade, or you could go on YouTube to find the basics. If you need a mentor, hit me up on Instagram to ask me any question. Step 3 is to start trading and compounding your account. To find a good compound calculator, you can go to compounddaily.org. You want to add your initial investment, how much percentage growth you want to see a day, how much days you want to trade, your daily investment rate, and if you want to trade in weekend.
All right, so that's the end of that one.
Well, there you have it.
Yeah. So I guess I'll redo the Wealth Mathers milestones. That step number 1 is not $1,000 in your emergency savings. Step number 1 is open up a binary options account on TD Ameritrade.
I think we're obsolete.
Disseminate that to clients.
What value do we have to offer now that we've this is out there?
Exactly. All right. Let's see what Timmy here has to say about investing. So bear with me 1 second.
I'm in front of Chick-fil-A now, which means it's time to become millionaires. Instead of buying ketchup, you can get it for free. And if you invest the savings into the S&P 500, that could make you a millionaire.
All right. So bear with me 1 second here.
So is Timmy selling his ketchup on the black market?
Is he opening up Timmy's ketchup booth right outside Chick-fil-A? Because if that's the case, then hey,
So I've seen these videos as well. Is that people walk into Chick-fil-A, they order something, but then they like fill up like a purse full of ketchup, and then they take it home. I like where Timmy's head's at. The one thing I'll point out though is that I can buy like a bottle of ketchup at Costco for like $10, and our family won't go through it for like 6 months.
What is it, the Chick-fil-A ketchup?
On investing $10 every 6 months, you might want to find another hobby. But
I want to see Timmy in 30 years and see where he's at, the ketchup millionaire.
Or he'll be in prison because Chick-fil-A is tired of them taking all their ketchup. So, all right. Okay. Okay, we got 10 minutes here. We'll just get this going.
So people keep asking me, how are you so rich? How are you so wealthy? How are you affording all these cars? I actually don't even use my own money to buy all this. I buy all my real estate with the bank's money, all my cars with the bank's money. I don't even use my own money. You can actually buy cars like these just like I do with no money down, none of my own money at least. So what I do is called leverage. So what I do is I go over to the bank, get money from the bank, use it as a down payment on a house, either apartment buildings, and the money that comes back, it's all mine. If you want to learn how to be rich like me, follow for more.
All right, yeah, you want to be rich like this guy. Leverage is the key, obviously.
Yeah. I think last time I heard a pitch like that was actually at the conference of the Hilton Garden Inn with those real estate guys saying buy with other people's money.
Exactly. Yeah. We all know nothing bad has ever happened when you use a bunch of leverage.
Absolutely not.
No.
Well, it seems to me like the Securities and Exchange Commission could probably be better stewards of taxpayers' money if they were running around chasing down some of these guys than trying to get in the way between folks who are placing trades at no commissions and allowing small investors to invest.
Yeah.
It seems a little more egregious than what Wall Street Bets is doing right now. So
yeah, that guy's for sure on there. And I don't even know if he's 18 though, so you can't even charge him as an adult yet. So
I think he probably parks cars as a valet in
that's the thought I had.
Yeah.
some ritzy restaurant.
He probably does, and he probably makes a comfortable living off of his TikTok revenue through ads. So more power to him. Keep it up. It's America.
All right, so we'll just do 3 today. If this works out all right, we'll do more of those in the future. But that's it for episode 10. Remember, if you want to participate in our discussion, you can leave a comment. You can also like our video just to let us know how we're doing. Otherwise, we'll see you next week.